Richard was 58 years old in September of 2008. 31 years at the same manufacturing company outside of Cleveland. He had done everything by the book. Maxed out his 401k every single year, took the full company match without fail, never borrowed against it, never panicked during the dot-com crash. His advisor told him to stay the course, and he listened. His wife Margaret packed lunches for both of them every day for 20 years to save money. They drove their cars until the odometers broke. They put 3 kids through Ohio State without touching a single dollar of retirement savings. Every sacrifice pointed toward one number, $1.2 million by age 65. That was the plan. That was the promise. By October of 2007, Richard had $847,000 in his 401k. He was on pace, 7 years to go. His advisor ran the projections every quarter, and the answer was always the same. You are right on track, Richard. Stay the course. Keep doing what you were doing. His oldest friend, Frank, had taken a completely different path. They had grown up on the same block in Youngstown, same blue-collar neighborhood, same era. Both of them shaped by fathers who worked with their hands and distrusted anything they could not see or touch. Frank's father had worked at the steel mill for 34 years and never trusted Wall Street after watching what happened in the 70s. He used to say the same thing every time the market made the news. They will take everything from working people if working people let them. Keep cash, keep your head, and when they all run for the exits, you walk in the front door. Frank listened to his old man. Richard thought that kind of thinking was stuck in the past. By February of 2009, Richard opened his quarterly statement and his hands started shaking. His $847,000 had become $457,000. $390,000 gone. Not over a decade, not over 5 years, in 16 months. He was 59 years old, 6 years from his target retirement date. Nearly half his life savings had evaporated. He called Frank that weekend. Frank told him his portfolio was down about 11%, and it was still generating $2,900 a month in dividend and interest income. Frank had $623,000 in total assets, less than Richard started with, but Frank had cash reserves sitting in a money market account. He had individual treasury bonds maturing on a schedule. He had dividend-paying blue chips that had cut their payouts but were still sending checks. And Frank had just deployed $40,000 into the S&P 500 the previous week at what he called a 60% off sale. Same generation, same values, same starting point. Richard was down $390,000 and paralyzed with fear. Frank was down $69,000, still collecting income and actively buying. Richard spent weeks researching what Frank had done differently. What he discovered kept him up at night. Not because it was complicated, because it was simple, and because nobody had ever walked him through it in a way he could actually use. My name is Ban. I spend an unhealthy amount of time digging through financial data, economic history, and portfolio research because I'm convinced that the gap between people who survive a crisis and people who get wiped out by one has almost nothing to do with intelligence or luck. It comes down to structure. And that structure is widely available, but almost never explained in plain language to the people who need it most. It sits in academic journals and behind professional certifications, while everyday investors are handed a simple slogan: stay the course. If you lived through 2008, you already know what I'm about to describe. If you are watching this today and you are 5 years or 10 years from retirement and you cannot afford to lose 40 or 50% and wait a decade to recover, this video is for you. I'm going to break down exactly what happened during 2008, why it destroyed some people and created generational wealth for others, and the specific 3-level system that determines which side you land on. Hit subscribe and drop a like because this took weeks to research, and the more engagement it gets, the more people see it. The S&P 500 peaked on October 9, 2007 at 1,565. By March 9, 2009, it had fallen to 676, a decline of approximately 57%. If you had $500,000 invested in a broad market index fund at the peak, by the bottom you were looking at roughly $215,000. If you had $1 million, you were staring at $430,000. That is watching 20 years of disciplined saving get cut in half in 17 months. And it was not just stocks. Unemployment went from 4.7% in late 2007 to 10% by October 2009. Lehman Brothers went bankrupt. Bear Stearns was acquired under distress. Washington Mutual became the largest bank failure in American history. People who had saved responsibly for decades were facing the possibility they might never retire. Here's the most important concept in retirement planning, and the reason Richard and Frank had such different outcomes. It's called sequence of returns risk. A market crash does not affect everyone equally. It affects you based on when it happens relative to when you need your money. If you are 40 years old and the market drops 57%, you have time. You keep contributing. You keep buying at lower prices. By 2013, about 5.5 years after the peak, the S&P 500 recovered to its previous high. By the end of 2021, that original $500,000 with dividends reinvested would have grown to approximately $1.45 million. Even without reinvesting dividends, price appreciation alone would have brought it to roughly $1.025 million. Time heals the wound. But if you're 59 like Richard, time is not on your side. His $847,000 dropped to $457,000, and he needed that money within 6 years. Every dollar he withdrew at the bottom never participated in the recovery. The market recovered, his portfolio did not. That's sequence of returns risk. In 2008, it ended the retirement plans of millions of Americans. So how did Frank survive it? 3 levels. You need all 3. Miss one and the whole system falls apart. Level 1 is liquidity. This has to be built before the crisis hits, not during, before. Frank had 6 months of living expenses in a high-yield savings account, not invested, not at risk, just sitting there. If the water heater broke or a medical bill showed up, the money came from here, never from his portfolio. This wall between emergencies and investments was non-negotiable. Second, he kept roughly 20% of his investable assets in a money market fund. This was his dry powder, his war chest. When the market went on a 57% off sale, Frank was not watching helplessly, he was shopping. I need to be upfront about the trade-off. In a bull market, that cash drags your returns. If the market goes up 30% and 20% of your portfolio earns 4%, you underperformed significantly. This strategy is not about maximizing returns in good times. It's about surviving bad times and being positioned to buy when others are forced to sell. That's a conscious trade-off you need to accept before committing.
Today, this strategy is more powerful because you are getting paid to wait. SWVX is yielding around 4.2%, USFR about 4.1%, SHV in the same range. These yields fluctuate with the federal funds rate, so always check current rates. But right now, your war chest earns 4+% while it sits there. One important note on taxes. Inside a 401k or IRA, moving between money market and equity funds has no tax consequences. In a taxable brokerage account, every sale and dividend generates a taxable event. Money market interest is taxed as ordinary income. Factor this into your planning. And here is why liquidity matters beyond opportunity. In 2008, millions lost their jobs. If you have no cash reserves and lose your income, you sell investments at the worst possible time just to pay your mortgage. Those shares you sold at 57% down tripled over the next decade. Someone else bought them. Cash is not trash during a crisis. Cash is oxygen. Level 2 is psychology. This is where 90% of investors fail. This is not about math, it is about your stomach. If ribeye steaks dropped from $20 to $10 a pound, would you throw away every steak in your freezer? You would fill your cart. But when stocks drop 50%, people do the exact opposite. They sell everything in panic and lock in losses permanently. In 2008, the narrative was not stocks are cheap. The narrative was the financial system is collapsing, banks are failing, capitalism might be ending. People locked in 50% losses because they could not take the pain. They sold at the bottom, the market came back. They did not.
Your share count does not change in a crash. 1,000 shares before is 1,000 shares after. Only the price changed, and the U.S. broad market has recovered after every major crash in history. But recovery timelines vary enormously. After 1987, about 2 years. After 2008, 5.5 years. After 1929, 25 years. I should note this pattern applies to the U.S. market specifically. Japan's Nikkei peaked in 1989 and took over 30 years to recover. Broad diversification across geographies matters. The market recovers, but the timeline can be much longer than people expect, which is exactly why this income and liquidity structure matters so much. You need cash flow regardless of what the market price is doing. The only way you permanently lose in a broad index fund is if you sell during the decline. Train your brain now in the calm to see red numbers as discounts. The people who bought in March 2009 tripled their money within 6 years because they could tolerate the discomfort. Level 3 is aggression. This is where real acceleration happens. In normal markets, you dollar cost average, same amount, same schedule, every month. But in a 2008 type scenario, you deploy your dry powder on a predetermined schedule, and you decide that schedule now, before the storm, because when headlines are screaming, you will not think clearly. Frank's framework: market down 20% from its high, deploy 25% of dry powder. Down 30%, another 25%. Down 50%, deploy everything remaining. He wrote this on an index card and taped it inside his desk drawer. No thinking during chaos, just execution. This feels terrible in practice. You invest $10,000 Monday, by Wednesday it is $8,000. You invest another $10,000 Thursday, by Tuesday it is $7,500. Every deployment feels like catching a falling knife. Level 2 saves you here. Trust the history, trust the math. I need to acknowledge a limitation. What if the market drops 20%, you deploy your first tranche, and it immediately recovers? Your dry powder sat in cash while the market rallied without you. This system is not designed to time the bottom perfectly. It is designed to ensure you were buying during major dislocations rather than selling. You will sometimes be early. You will sometimes watch it fall further. The goal is approximately right during extreme fear, not precisely right. Now the defensive structure in practice today. Equity allocation should tilt toward dividend payers. SCHD yields about 3.5%. In 2008, while the S&P 500 price dropped 57%, dividends per share only fell from $28.05 to $22.41, roughly a 20% decline. Your value got cut in half, but income dropped by a fifth. VYM and DGRO offer similar exposure. Dividends are not guaranteed. GE cut its dividends 68%. Every major bank cut or suspended dividends. Diversified ETFs spread this risk, but even they see income decline in severe recessions. Plan for 20 to 30% reduction and make sure your treasury ladder covers the gap. For bonds, use individual treasuries held to maturity, not bond funds. In 2022, BND lost 13%. An individual treasury held to maturity pays full principal plus interest regardless of interim rate movements. Build a ladder with maturity staggered 1 through 5 years. At current yields of 4 to 4.5%, that is serious predictable income. If your state has income tax, consider in-state municipal bonds. A 4% muni yield equals roughly 5.9% pre-tax for someone in the 32% bracket. The formula is muni yield divided by 1 minus your marginal tax rate. Framework for 5 to 10 years from retirement. 20 to 25% short-term treasuries, money market, or cash. 25 to 30% treasury bond ladder. 30 to 35% dividend equity funds. 10 to 15% broad market index funds. This is a framework, not a prescription. Your situation is unique, and these numbers should be tailored to your specific circumstances. Now the current environment. The CAPE ratio is elevated, in the range of 33 to 38. Long-term average is approximately 17. It was in the mid-20s before 2008 and 44 before the dot-com crash. Elevated CAPE is a valuation signal, not a timing signal. It means expected future returns from current prices are historically lower. 3 signals to watch. First, the yield curve. The 2-year, 10-year Treasury spread has preceded every NBER-defined recession since 1955, with one debatable exception in 1966. It was inverted for a record 26 months and recently uninverted. Historically, recessions arrive 6 to 18 months after uninversion. We are in that window. Second, the SOM rule. When the 3-month moving average of unemployment rises 0.5 percentage point from its cycle low, recession has historically begun. This briefly triggered in mid-2024, though creator Claudia Sahm noted immigration-driven labor force growth may have caused a false signal. Amber signal. Third, corporate earnings revisions. A significant majority of S&P 500 companies saw forward estimates revised downward in early 2025, driven by tariff uncertainty. The breadth of cuts was notably wider than the 5-year average. No single indicator predicts a crash. When 2 or 3 flash simultaneously, your positioning needs to be in place already. Back to where we started. Richard had $847,000 in October 2007. He froze, stopped contributing, sat in cash for 2 years after the recovery started because he was terrified. By 2013, his portfolio had only climbed to about $620,000. He retired at 67 with $780,000. Smaller house, fewer trips to see grandkids. Social Security became the backbone. Frank deployed $40,000 between November 2008 and March 2009, with the S&P 500 trading between roughly $750 and $680. By 2015, that $40,000 alone had grown to approximately $110,000 to $120,000. His total portfolio crossed $1.1 million by 2018. He retired at 63. Dividend income covers basic expenses. Social Security is the bonus. Same generation, same neighborhood, same values. 2 completely different retirements. Frank's old man tried to teach both of them. One listened. Most investors only know one game: accumulate, buy, hold, hope. For the first 20 years, it works. The last 10 years before retirement and the first 10 of retirement are a completely different game. You need both offense and defense. A good advisor will walk you through this, but many investors either lack an advisor or have one who has never stress-tested their portfolio against a 2008 scenario. Now you can do it yourself. Look at your portfolio right now. 3 questions. How much cash do I have if markets drop 40% next month? Are my bonds individual bonds or funds that can lose double digits? If the market crashed tomorrow, am I buying or selling? Build your 3 levels: emergency fund, dry powder, psychology trained in the calm, deployment plan written down. Check those 3 economic signals once a month, not every day, not every hour, once a month. Share this with someone who needs it: a spouse, a friend, a coworker, someone who remembers 2008, someone who has worked too hard for too long to lose everything because nobody walked them through the full picture. Hit subscribe because next week I am breaking down Social Security timing, why the difference between claiming at 62 versus 67 versus 70 can mean hundreds of thousands of dollars in lifetime benefits depending on your specific situation, health, and marital status, and I will show you when claiming early actually makes more sense. That video could save you a decision you cannot undo. This is Ban. Stay sharp out there.